This episode is brought to you in partnership with Forex.com, a leading provider of online trading services. Remember, trading Forex and CFDs carries risk and isn't suitable for everyone.
This is not beating up the US because the US is in many cases one of the cleanest shirts in the laundry. If you start to look at France or Britain, I assure you it's a lot worse than this.
US debt 30 trillion, it's out of control. The refinancing on this is again scaling out of control. Where are we going? Hello and welcome back to another episode of Two Blokes Trading. Today we're joined by Michael Howell, one of the sharpest minds in global macro. He's the founder of CrossBorder Capital and a leading expert on liquidity, the real fuel behind market moves.
Markets are no longer about raising new capital for investment ventures. The primary transactions, 80% of those are debt refinancing transactions. The trend in financial liquidity has got to be upwards because the only way that you're going to afford this debt or the spending is by printing money. Bitcoin is a very, very good barometer of liquidity conditions. And my sense is the Fed is certainly pushing against that idea as much as they can. What you could think of in the textbooks was a 10-year business cycle. This is a 5 to 6 year debt cycle. The problem the Federal Reserve has is that they're the ones that have caused this problem. And you can see it here because this is something we call Fed liquidity, which is the active part of the Fed balance sheet. In other words, it's the bit that creates liquidity. So you're getting a 40% decline in Fed liquidity. And look what happened to the markets. They crashed. What you see is that the gold price, which is, around $4,000 an ounce now, would be $10,000 an ounce by the mid-2030s. And an eye-watering $25,000 an ounce by 2050.
In this episode, we break down why liquidity matters more than interest rates, how today's debt levels could trigger funding crunch, and what traders need to watch as volatility rises. If you want to trade with the tide, not against it, this one's for you. Michael, welcome to Two Blokes Trading. Thank you so much for taking your time out your day today to join us.
Well, great pleasure, Jonathan. Good to see you. Good to be here. Lots going on.
Well, what's going on? There's a lot going on in the markets right now, and there's so much to speak about. Obviously, your background is fantastic, and we actually haven't had someone of your kind of ilk on the podcast before, so it's going to be really interesting to kind of deep dive into volatility and so on. So, I suppose before we jump into all of that, give our listeners a bit of a background in terms of how you got into the trading world in the first place.
Well, I suppose to be accurate, I'm on the research side, but a lot of what we do is actually used by traders pretty extensively. The origins of what I do go back to a couple of decades or at least ago when I worked for the US investment bank Salomon Brothers. And Salomon was the world's biggest bond trader, as many people will recall, now part of Citigroup. But that's the way of the world, I guess. And Salomon Brothers was pretty much the fixed income markets worldwide. And to understand the fixed income markets, you had to understand credit flows, capital flows, what central banks were doing, etc. And, here we are now. But the world has changed a lot in those 3 decades. And I think, the way to understand this is really to say probably 2 things. I mean, one is that markets are no longer about raising new capital for investment ventures, as the textbooks tell us. They're there really to refinance debt. Something like 80% of transactions in global financial markets, the primary transactions are now 80% of those are debt refinancing transactions. So what you're really looking at in the markets is a debt refi cycle. And that's how we've got to think about it. So that's number one. And I think number two is that if you look back, 20, 30 years, the big players in markets were principally pension funds and insurance funds. And they were, investing our savings and arbitraging against fixed income. And the common metrics they'd look at would be things like the yield spread between equities and bonds, and they'd make their decisions accordingly. The world's changed. I mean, that's not going on.
60
pension funds have been eclipsed. Yeah, the 60-40 model. I mean, the pension funds have been eclipsed. They're in drawdown. They're not really big investors in risk assets anymore. Etc. What you've got now is a lot of leverage. You've got hedge funds playing. You've got leverage pools of capital that swing around in these markets. And what that's governed by is not the fixed income markets, but really the repo markets. And it's the repo markets which are kind of unraveling right now. They're potentially breaking, and we need to understand why.
This is why we have you on, huh? So yeah. I mean, look, liquidity is a big thing for you, right? I mean, that's your go-to. This is what you follow in the markets, and you believe upon liquidity more than anything else in terms of how you actually analyze the market, right?
Correct. I mean, what we're doing is we're basically understanding the fact that money moves markets, and we're tracking money, and we're looking at the flows of money worldwide, and we're trying to understand the direction and maybe the inflection points. And we stress liquidity, which is a bit different from money. Money has got sort of a fairly fixed or rigid definition, which is the deposit liabilities of high street banks. That's what people think of as M2 money. But, the world's moved on from that too. The world is not just about high street banks. It's about big financial institutions. It's about hedge funds, as I said. You've got to start understanding the flows through financial markets. And it's that which we think of as liquidity. And what's more, it's global. It's not local. What happens in Japan or China or the US clearly affects Europe enormously, and vice versa.
Sure. And when we talk about liquidity, and that's what you look at, what about when we have economic data coming out and all this kind of information as well? Like, is that something that you also look at, or is that you purely based upon liquidity?
Well, to say we don't look at it is wrong. I mean, we don't put it as high priority.
Really?
I think you've only got to look at the US, in the last few weeks to realize that with the government shutdown, there's been no data. I mean, has it made a difference? I would say not. Markets, we still wake up every morning. Markets still go up and down, and no one seems to bother too much about the lack of economic data. The fact is that money moves markets, not economic numbers so much.
For sure. Look, we're seeing so many big investment hedge funds and so on start to kind of pull back their portfolios as well at the moment. I mean, are we going towards a squeeze at the moment? Obviously, we are. I mean, look, what, US debt 30 trillion. I mean, like it's out of control. The refinancing on this is again scaling out of control. Where are we going? What direction?
Well, I mean, ultimately, we've got to think of the financial system as having a trend and a cycle, and I think that it's fair to say that given the sort of train wreck of government finances worldwide, the trend in financial liquidity has got to be upwards, because the only way that you're going to afford this debt or the spending is by printing money. And that is the sad reality of what we're looking at. And that tells you pretty much why there is a clamour to get on the sort of gold train as fast as anyone can, because a lot of investors realise that gold is a really good hedge against government, government monetary money printing, if you like. And that's ultimately what we got. But the other thing we've got to recognise is that markets never go up in straight lines. There's a cycle we've got to pay attention to. And that cycle is a cycle both in liquidity and in sort of risk exposure, risk appetite.
Absolutely.
We've got to understand those two dimensions. Now, there's a slide that we can show, which is looking at weekly global liquidity, which is a chart, bright orange admittedly, but that's not necessarily supposed to be an amber traffic light. It's just basically looking at the course of global liquidity, over the track of the last 4 years. And what it shows is that really since the low point towards the end of 2022, which you can see there, global liquidity has been on a tear upwards. Yeah. And, despite the fact that we've had, doubts about the economy, uncertain prospects for interest rates or whatever else, the fact is that liquidity conditions have actually expanded dramatically over that time, partly because the Federal Reserve in America has been, let's say, less than straightforward about its operations. It's actually been throwing quite a lot of money into the US system over that period. There's been changes in the way that the US Treasury itself operates. So it's been undertaking a lot of bill financing, which means that they're financing the government at the very short end of the market, which has actually helped liquidity conditions. And then the other elephant in the room is what China's been doing. China, certainly since the beginning of this year, which explains a lot of the recent rally in liquidity, has been pumping a lot of cash back into its markets for the first time in 2 or 3 years. And that's why the Shanghai stock market is also racing ahead, why gold is going up, etc. So you can see here that liquidity has been on a tear. The problem is that, as we know, markets never go in straight lines. And if you look at the following chart, this is an index, which is actually a daily index that we create, which is looking at the momentum. It's an index of momentum of liquidity. So whereas the other one was measured in US dollars, this is measured in terms of rates of change. And we've got two metrics there. One is a simple liquidity nowcast, which pretty much says what we've been arguing, that you're looking at an inflection, you're looking at a progressive slowing down in liquidity, which is why markets are becoming, more and more difficult to trade. And then the other line is really a more conventional measure of market liquidity, which is the internals of the market, looking at bid-ask spreads, looking at measures of volumes, etc. And it's really a measure of the depth, the trading depth of markets. And you can see that pretty much matches the global liquidity nowcast, but it lags a little bit. And so what we're seeing, we think, are growing tensions. And those tensions are really coming out of the repo markets in particular.
Right. And it's interesting you say, right? We know that gold is flying at the moment, and we know the reasons behind that, right? Geopolitical reasons, safe haven reasons, and so on. But we're still also seeing the stock markets flying at the moment. I mean, at what point does that turn?
Well, I think you've got to look at a sequence here to be fair. I mean, everything doesn't necessarily happen at once unless there's a big rug pull. You tend to see different assets responding with more sensitivity to liquidity than others. And, principally right at the front in terms of high sensitivity are things like gold, silver, and otherwise precious metals, and Bitcoin. And Bitcoin is a very, very good barometer of liquidity conditions. And the fact that you've had, admittedly, gold has been racing until it hasn't, but the sharpness of the decline in gold is probably telling us that it's hitting a bit of an air pocket. And the fact is that Bitcoin has been kind of range trading recently. It's had ups and downs this year, but it's not really delivered great performance from January through now. It's kind of treading water overall, but there's been a seesaw in between. And right now you're looking at Bitcoin finding it tricky to make more progress. And I think that's down to the fact that liquidity conditions are kind of stalling out here. They may. Don't get me wrong. They may go up again, but I think we're pretty much in the hands of what the Federal Reserve and maybe the People's Bank of China are up to, and we've got to look at them pretty closely. And my sense is the Fed is, not really willing to come back in size quickly into markets and to do the necessary job, which is actually to inject more QE into the system. They're certainly pushing against that idea as much as they can. And what's more, Treasury Secretary Bessent in the US has actually pretty much almost said categorically they can't do it because he said it creates too much of a wealth divide between Wall Street and Main Street in terms of US society. So it's now, as he keeps saying, it's now Main Street's turn, and that's pretty much, I think, how we read the US administration's policies.
Sure. And I suppose looking at where we're going at the moment, I mean, do you foresee 2026 seeing a huge downturn at the moment? Is that something on your agenda, what you're looking for? Obviously, we've got AI holding things up. Obviously, the Mag 7s are propping up everything at the moment. But I mean, there has to be so many top voices out at the moment are warning of there will be a downturn. But how long can AI and all these tech firms prop up the considerable problems and issues that they're underlying?
A big thanks to our sponsor, Forex.com, for supporting this show and keeping it free for all of you. One feature I think a lot of traders will love is that you can actually link your Forex.com account directly into TradingView. So instead of bouncing between platforms, you can analyze a chart, spot the setup, and place the trade right there. Another tool I really rate is their performance analytics. It doesn't just tell you your wins and your losses. It shows you patterns, like what time of day you tend to trade best, or which strategies are really working for you. That kind of feedback can make a huge difference over the long run. We're able to keep putting on these episodes every week thanks to partners like Forex.com. And if you're looking for a broker with strong tools and integrations, they're definitely worth a look. Just a reminder, trading Forex and CFDs carries a risk and is not suitable for everyone, so always trade responsibly. If you want to check them out, there's a link in the description.
Well, I think there's a couple of things to say, Jonathan, on this. I mean, one is that a lot of those people that are called, let's say, shouting warnings or screaming fire are saying that largely because markets have gone up a lot, and on conventional valuation metrics they look expensive. But after all, I think you've heard those sort of cri de coeur many times over the last 2 or 3 years, and nothing's happened. The reason it's different this time is that what you're actually beginning to see is high valuations for sure, but you're also looking at liquidity conditions starting to inflect. And what I've got is a chart which is our sort of centerpiece, which is the global liquidity cycle, as we call it, which is an index of the momentum of liquidity through financial markets, going right back to the 1960s. And what you can see is the black line, which is the actual data. The last read was September, end of September this year. And the dotted line is a sine wave that we put on top of that to show there is a regular 5 to 6 year cycle. And that 5 to 6 year cycle is a debt refi cycle. Okay, so this liquidity is really reflecting the ups and downs, are reflecting the movements or the need to refinance debt in different blocks of debt. Basically with a 5 to 6 year frequency. So rather like the old business cycle that people think of in the textbooks was a 10-year business cycle, this is a 5 to 6 year debt cycle or debt refi cycle. Now, that cycle, as you can see on the chart, happened in October of 2022, pretty much exactly on track with the sine wave that we illustrate, and it's slated to inflect downwards in late 2025. Lo and behold, it looks like it's doing that, pretty much on track. We did have some thought that it might be extended by what the Fed is doing into early 26, but we're really only talking the difference of a few months. But we've got to try and understand why this inflection is currently underway and maybe why it could keep going. And that's really, one of the questions to ponder. Now, if I jump in and say, why is that going on? Let me show, two things. One is that if you look at the average length of a cycle, this is a liquidity cycle. The red line on this chart is looking at the latest cycle, and the dotted line is looking at the average cycle over the years 1970 to 2025. So what this is basically telling us is that, on average, we're pretty spent here. It may not be, inflecting lower, or the red line may not be falling sharply yet, but it looks like it's sort of lacking upward impetus. And that's what we've got to be alert to. Now, if I come on to the actual mechanics of the here and now, what's going on, what you can maybe see, or maybe if I start with this chart, what this chart is basically describing, and this is maybe a tad wonkish, but it's basically saying, look, if you want to understand the financial system today, don't bother picking up a textbook because, they're really so out of date. They're useless, frankly. What this is saying is the financial system today really rests around, or is built around, a debt liquidity nexus. And that debt liquidity nexus that I put in the central piece of that diagram is saying that financial stability means you've got to have an equilibrium between liquidity and debt. And the paradox that the system has is that debt needs liquidity for refinancing. So in other words, when you come up and want to roll your debt, you've got to have somebody who is effectively going to give you the capital or the liquidity to do that. A credit provider or a bank that's got the balance sheet capacity to do it. So you need that liquidity. Mm-hmm. But then the other side of that is that liquidity needs high quality debt, because something like, as the left-hand side says, something like 77% of all global lending is collateral backed, which is a World Bank figure. So you need that collateral, and that collateral tends to be things like US Treasuries or German Bunds, high quality debt. Therefore, there's that paradox at the heart of the system. Liquidity needs debt and debt needs liquidity. Now, when you start to go wrong on this, is you get a disequilibrium or a mismatch between these two things. And what goes wrong are the repo collateral markets. And you need to understand, looking at metrics like the MOVE index, which is a measure of volatility in the US Treasury market, or you've got to look at SOFR spreads, which are the spreads of repo rates, market interest rates, against Fed funds targets. Now, I'll show you a couple of charts. One is this one, which is one to ponder. And this is looking at the debt liquidity ratio of all advanced economies since 1980. This is annual data, but it illustrates the point quite neatly, that you've got an equilibrium, which is that dotted line. If you go above the equilibrium, above that dotted line, you'll see there that there are annotations, and those annotations refer to financial crises. So when you get a stretched debt liquidity ratio, in other words, too much debt in the economy, as people say, but you've got to measure it relative to some benchmark. And I'm saying debt to liquidity is the benchmark. When that debt liquidity benchmark is stretched, you get a financial crisis. And that's a refinancing crisis. You can't roll the debt over. So, you get potential defaults, and then central banks have to come in and bail the system out. And every one of those annotations refers to a past crisis, and every one is really a refinancing crisis. So that's what we're looking at. That's what we've got to watch for. The other side of that, on the lower part of the diagram, is when you get too much liquidity and not not enough debt, if you like, to refinance. The money's got to go somewhere. So the vent is financial assets. And then you start to look on the lower right, you see there's that big bite out of the chart, which is the everything bubble, as I've called it. And that is basically the last 10, 15 years. We've seen bumper returns on financial assets because there's been so much liquidity relative to debt. Why have we got ourselves in that situation when we know there's a lot of debt? Simple answer is, number one, every financial crisis, be it COVID, be it the GFC in 2008, has been met with more liquidity by central banks. QE has become part of the lexicon now. That's all they do. Every time there's a crisis, they'll expand liquidity, right? The other thing is that what they did in the COVID crisis, they dropped interest rates to near zero, which is pretty much unheard of in human history. When I was at Salomon Brothers, the Bible textbook was called A History of Interest Rates by a chap called Sidney Homer. He looked at 4,000 years of banking history, and nowhere in those pages was there any evidence, or is there any evidence, of zero interest rates. So that's how out of line we are. But that zero interest rate not only incentivized people to take on more debt, foolishly, but it also encouraged a lot of corporations, governments, and households to term out their debt into the latter part of the 2020s. So you've got all this debt which is likely to come back into the system, needing refinance in 26, 27, 28. And that's why that line, the orange line, starts to go up quite sharply. And that's where you're exposing tensions in the system. Now, those tensions are gathering and they're being expressed in the repo markets. And I want to show you this chart, which is the one that, really stands out in terms of daily impacts. This is the daily track of what's called the SOFR rate, which is the rate that now is the key short-term market interest rate in the world economy. So this is in US dollar, a US dollar rate in the US, but it's overtaken Eurodollar rates as really the key interest rate worldwide. And this is looking at it against Fed funds, the US policy rate target. Now, you kind of expect, given the fact that SOFR is collateralized and Fed funds isn't, that SOFR would trade at a tiny discount, which is what has happened. But the corridor of normality is shown there, the normal zone, where you kind of get this ranging pattern. And then you start to move out of that corridor on the upside, and you move towards the danger zone. And what you're looking at is more and more evidence of repo markets basically seeing shortages. So when you get shortages of liquidity or insufficient good quality collateral for borrowers, so that's basically saying, look, there's either a shortage of good quality government debt to borrow against. There could be deteriorating credit quality. There could just be a lack of it. Or you've got a lack of liquidity among the dealer banks to actually lend. Then you're going to get problems. And that's what we're seeing. And it's not necessarily the extent of those jumps that are the worrying thing for me. It's the frequency. And what we're seeing happens day after day after day. And, as again last night, the print coming out of the US was another big figure, for imbalances in the repo markets. And it's coming day after day. Now, the problem the Federal Reserve has is that they're the ones that have caused this problem. And you can see it here because this is something we call Fed liquidity, which is the active part of the Fed balance sheet. In other words, it's the bit that creates liquidity and which fuels asset markets from a US central bank standpoint. Now, this is the growth rate of what they're doing. And this basically illustrates that you've come from a period in 2021 where there was abundant liquidity. Look at the growth rate there, but that was COVID. Okay, so 80%, 60%, these are really high numbers of liquidity expansion. And then you start to go down into early 22, where you start to see the reverse. You're getting a 40% decline in Fed liquidity. And look what happened to the markets. They crashed. Stabilization from the back end of 22, as I alluded to. Good growth through most of the period. And you're getting 10, 20% growth in Fed liquidity. Then you get this air pocket at the back end of 2024, when markets again take a bit of a bath. A big rally through early 2025 because the Fed is pumping liquidity, technically because of this debt ceiling that you've had imposed on the US. So they've run down their treasury balances, etc. And now what you're getting is this period, the grey area that we've shaded there, which is really from now through to the middle of 2026, where you go down again, you've got this negative growth or actually contraction in Fed liquidity. And it's happening as we speak. So, this is the problem that you've got. And this is, well, I'll show you a better chart. This is US bank reserves against what we think is the minimum necessary. And this is where this all comes through. If the Fed doesn't provide liquidity, the banking system gets short of reserves. If the banks are short of reserves, then you get a problem in terms of the repo markets, and you get trade fails in terms of the markets. And you can see the red dotted line is our estimate of where they should be. So about, $3.3 trillion of reserves. And the orange line, and the dotted orange line, is our where's actual reserves and our projection of where that's going to sit. And you can see that doesn't look a happy picture because it's a big shortfall. Yeah. And so what are you getting in the system, which is sort of the final chart in this, is just to say, look, it's not rocket science. If you don't get the liquidity, which is the orange line, so the orange line is the differences between adequate reserves and actual reserves. So that shortfall is being plotted as the orange line. And the black line is upside down, measured on the right scale, but it calibrates the number of trade fails in the system. In other words, when dealer banks basically can't fulfill transactions and these things sour. And, pretty nice correlation there. And so what you've got is a situation where you could see a lot of disruption. Now, why is this a big problem? It's a big problem because if you start to see volatility coming into the bond markets because you're getting trade failures and a lack of liquidity and high repo rates, which discourage borrowing, the hedge funds are going to start to move out of the bond market.
Yeah.
And they've been powering through the so-called basis trade between Treasury cash and Treasury futures. And they've been big buyers. Now, a Federal Reserve paper, which didn't really get a lot of airtime, very recently said that if you calibrate, if you dig into the data, which is not transparent, you find that actually last year, the hedge funds are the key marginal buyers of US treasuries and basically whacked in about 1.5 trillion into the market. Now, these are big numbers. And so if they start to unravel, and they can unravel really quickly because hedge funds move fast, a matter of survival, of course,
sure.
You're going to see, a lot of disruption. So the Fed can't be complacent here. And the trouble is that, the noises that are coming out of the Fed are that they really want to tough this out. And, one of the key policymakers at the Fed who used to run the SOMA account, Laurie Logan, pretty much said in a recent speech, well, to sort of summarize her words, she said, look, if you're going to make an omelette, which is getting bank reserves down as a policy, you've got to break eggs. So the message is they're going to tough it out. And I think that's really dangerous.
Where do you see so with the current direction things are going, how do we make those changes? Is there any way out of this squeeze? It's hard to see, right?
Well, it's very hard. I mean, what's going to happen? I mean, Chairman Powell at the Fed has more or less said what's going to happen. He said, we're going to end QT, right? He said that in a speech 10 days ago. And you've got to expect that to happen in the very near term, maybe as early as next week or so. So that could happen, right? Unfortunately, that's not enough, because even if you end QT, you're not going to get liquidity back into the system in the size that's required. You're going to have to restart. They're going to have to restart QE. And that's being mooted already, that they may come back and do that. But that's what's necessary. The trouble is that, the administration doesn't want that because they say this is, featherbedding Wall Street too much, and we want to target Main Street. And so you're getting this sort of standoff between, if you like, Wall Street and Main Street. And I think that the way the administration is operating is that they want Main Street to win. So that's why I think this is kind of a dangerous situation. And all the time you're getting the federal deficit being very high, but they're funding it with short-term bills. And that's not a great, happy environment in the longer term. So it's not surprising that people are moving into gold.
Absolutely. I mean, realistically, the assets at risk are stocks, and also, like you say, bonds are at risk as well. But I mean, potentially dollar does better out of this. It's, like I said, that kind of riskier, precious metals, potentially Bitcoin. Again, there's a big issue with fiat at the moment. That's a different story and another conversation. Like realistically, once we get this squeeze, how long before people start pushing away from risk on assets?
Well, I think as I say, you've got to come back to two things, right? One is trend, one is cycle. The trend, I think, the trend in liquidity expansion is exponential. And I'm just going to explain maybe why that is in a chart that I've got right at the beginning of this presentation, which sort of puts this into perspective. Okay. This chart here is looking at what I call the US structural deficit. Now, this is not beating up the US, because the US is in many cases one of the cleanest shirts in the laundry. If you start to look at France or Britain, golly, I assure you it's a lot worse than this. Okay. But the US is very good with providing data, and it's very easy they're transparent and you can look at it. And this is showing projections of the US structural fiscal deficit out to 2050. So we're looking at 25 years hence, right? Now, that fiscal deficit, and bear in mind structural deficits surely should be at least zero, maybe even, the deficit should be on this scale negative, ideally, okay, where it has been for most of that period, okay, apart from the spikes, which was the GFC in 2008, spike number 1, and spike number 2 was COVID, right? Now, the structural deficit comprises of 4 factors, simply 4 programs: Social Security, Medicare, defense, and interest payments. So that's all it is. There's no discretionary elements in that at all. If you look at that orange line is trending higher. You're getting up to 10-12% of GDP in fiscal deficit. That's even without, things like, roads, infrastructure, whatever else governments do. Okay, this is simply those 4 programs. And that shows the burden that they're taking. The interest bill is escalating because it's interest rate compounding. Defense is a big number, as we know, 5% of GDP. Medicare and Social Security are just winging upwards because of aging demographics and the welfare commitment that even America has made to its people. Put that in European terms, and wow, that looks a lot worse. And the dotted line there is looking at debt held by the public as a percent of GDP. Now, those figures are largely based on Congressional Budget Office projections. The Congressional Budget Office in the US is a bipartisan body, so it's pretty much neutral. They come up with conservative figures. They don't even factor in recessions here, which would blow these numbers out even more. And you kind of get the picture that, what we all need to come to terms with is this radical increase in the size of these fiscal deficits. This is not what we're used to. This is a new world. Everyone's got to get used to it. And the worrying dimension is looking at this, which is saying if you take that public debt to GDP ratio, the dotted line, same one, and you make a very simple assumption. And that simple assumption is that gold matches that increase in public debt. So in other words, what you're doing is you're saying, let's keep the public debt to GDP ratio fixed in gold terms. So we basically move gold up with the growth of GDP and the growth of this ratio. So what would happen to the gold price, assuming the stock is the same, in terms of fulfilling that criteria? So what you see is that the gold price, which is around $4,000 an ounce now, would be $10,000 an ounce by the mid 2030s, and an eye-watering $25,000 an ounce by 2050. And that's simply doing this maths. Now, if anyone says, well, of course, that's fanciful, it's never going to happen, is it? Well, let's just think back what happened in the last 25 years. In the last 25 years, US debt from year 2000 to 2025 has gone up 10 times. So debt now is $29 trillion marketable debt in the private sector. Is $29 trillion. So it's gone up 10 times in 25 years. The S&P 500 has gone up 4.7 times. So actually pretty decent return, but it hasn't matched debt. Gold has gone up 13 times. And gold has more than matched the increase in the fiscal debt. And that's what you expect, because it's a monetary inflation hedge. And printing money to fulfill the deficit and to cover the deficit and to basically cover debt is monetary inflation. And that's what we've got. And therefore, you need in your portfolios gold, precious metals, Bitcoin, anything which is a monetary inflation hedge. Yep. And that's why there's this appetite. But there's a cycle. So would I be chasing these things right now? No. But I'd be taking a view that said, I'm going to add to them on any weakness progressively.
Interesting. This has been a lesson for me, I'm going to be honest. And whoever's listening to this or watching on YouTube, well, it's been an absolute lesson. It really has. And tell me, like, for traders listening in who want to kind of get access to information, especially around volatility, like, what's the best indicators? Where should they look for this data?
Well, I think first of all, we've got a Substack called Capital Wars, which basically, runs through both narrative and provides data on what's going on, at least 3 times a week.
Fantastic.
We write. So that's one source. We have an institutional service, which is, much more detailed and provides data as well, particularly for quant firms. We do a lot of that. And if you want to do it yourself, the most ready takeaway is to go to the, the Fred website. So it's FRED, which is the St. Louis Fed. And alternatively, look at the New York Fed website because they give a lot of information. But you can really glean a lot about the repo markets from those two sources. But you want to be looking at the SOFR rate vis-a-vis Fed funds, and just look at some of the the tension, the indicators they throw up, which are highlighting tensions in markets. And that's what you've got to start to figure, because I think that's what really matters.
100%. And we'll put all the links in the descriptions as well. So make sure to check them out, guys. So, look, thank you so much. I tell you, also, you have a book as well. Obviously, is there any more books coming out, or?
I was afraid you were going to ask that question. Yeah, there's a book I wrote about this stuff about 5 years ago now called Capital Wars. It's still pretty relevant. It was largely sort of tackling the capital war between China and the US, and it detailed why liquidity is very important. And it was really trying to say that, all this stuff about trade wars is just veneer on top. The real battle is about capital, the supremacy of global capital. And America wants to win, and China doesn't want it to win. It wants to win itself. So that's what all these tensions are really about, ultimately. But that book is called Capital Wars.
And no more on the agenda now?
Well, I'll try, but I can't promise you. I'd tell you they take so long to do.
Yeah, for sure. Well, look, again, like I said, this has been a real eye-opener for myself even. Thank you so much for joining us today, Michael. It has been an absolute pleasure.
Thank you, Jonathan. Enjoyed it. Thank you.
This episode is brought to you in partnership with Forex.com, a leading provider of online trading services. Remember, trading Forex and CFDs carries risk and isn't suitable for everyone.